Good morning from our New York studio. My name is Gad Lebanon and I'm Chief Economist North America here at the Conference Board. Welcome to our July edition of Economics Watch. I will soon introduce my fellow guests here, but just to start off, to let you know what we're going to focus on today. As you know, we do a lot of work here on labor markets in the United States, and one of the things that we'll focus on today is what's happening underneath the national level, what are labor market conditions across occupations and across locations. So we are going to talk about that, but that's after our regular global and US economic outlook. Just to remind you that if you're interested in CPE credits, they are available. Please type your full name and email address in the space provided and click OK for 3 pop-ups that occur during the program. You need to stay online for the entire webcast to get the credit, and credit is only available for live participation. Today with me are 3 of my colleagues here at the Conference Board. I'll start from all the way on my right. Brian Shaitkin, Senior Economist here at the Conference Board and a regular guest, sometimes host here on Economics Watch. Good to have you again, Brian.
Thank you, Gad.
And Ataman Uzildarim, Director of Business Cycles and Growth Research here at the Conference Board, who probably participates half of the time, so you're also familiar with him. Welcome, Ataman.
Good morning, Gad.
Yeah. And right to my right is Frank Stimmers, Associate Economist, and he works on labor markets, and he will, together with me, present some of the new material on the labor market conditions by state. So welcome, Frank.
Good morning, Gad.
So we're going to start as usual with the global outlook, but before I hand it off to Ataman, we would like to hear what you, our audience, think. So we have a polling question here, and the studio is going to put it on in a second. So the first question is, global growth would benefit most from which of the following? A return to lower oil prices, containment of dollar appreciation as Feds raise interest rates, reduced trade tensions between US and major partners. So again, those 3 options. Let's give it 5 more seconds. 5, 4, 3, 2, 1. Okay, so I guess none of you are concerned about the dollar appreciation, but it's a clear result that the main concern now in the global economy is the trade tensions between the US and major partners. So we are happy that you think that, because we have a lot of material on that topic that we will discuss later. Any quick initial thoughts on those results?
Yeah, so that's very interesting and probably not too surprising. We're hearing about trade in the news all the time. And while we were expecting an imminent trade war, I think it's kind of becoming more of a full-blown trade war. And it's not just with the major trading partner of China, but it's also with Canada, Mexico, and European economies. So that does touch on sort of industries across the board. So probably not surprising to see that. The dollar appreciation is probably not a major problem for US businesses, but it becomes more of an issue for businesses and the economies of emerging markets. So their currencies are weakening, and that creates sort of more imbalances in their macroeconomy. So for US businesses, though, of course, dollar appreciation is not such a bad thing. And also for US consumers, because then they can afford more, considering that prices of imports are going to be going up.
Yeah. Great. So, Ataman, why don't we continue with now what we think about the global economy?
Yeah, so we have kind of adjusted the global outlook for 2018 just slightly down to 3.2%. Around the world, the business cycle is maturing, getting to the later stages with employment rising, unemployment falling, and interest rates starting to rise. So the economies around the world are operating at or above potential. So that's good news for the expansion. But there is a downside to that because it could increase these risks and imbalances. And we're beginning to see that some of that global story might be changing looking ahead. There might be some trouble spots that are emerging. But overall, the major areas of the global economy are still strong. The US economy, we'll see from Brian that it's performing above potential. It's very strong and still getting more policy stimulus that helps the US economy, and that also helps bring up the global growth rate as well. There's more of a concern about the euro area economy starting to moderate going into the latter part of 2018, sorry. So the better than expected performance of the euro area until now was mainly driven by net exports, and we don't see that continuing going forward. And the domestic side, consumer spending is there, but it's probably not enough to offset the support from net exports falling. And the euro area is also hitting supply constraints. So unemployment is coming down. That'll raise wages and inflation there as well. So ECB will be starting to think of taking away the stimulus. Again, that will help to slow down the European economy. So the moderation in the euro area is kind of a spot in the global economy that's going to have slowdown, moderation for the global economy. Emerging markets are doing fairly well, but their strength comes more from their domestic consumer and investment spending. Rather than the sort of export-driven growth that emerging markets are used to. And we don't project an acceleration for the emerging markets. Rising high oil prices that some people responded to on the poll help some of those emerging markets, but they hurt others that are importers of oil and energy. So the trade tensions, the trade war is really creating a lot of potential disruption. The immediate impacts may not be very large, although we are starting to see prices of imports rising, and that's going to have those knock-on effects on consumer spending and feed in through the pipeline. As intermediate goods become more expensive, they'll get reflected. And to the extent that companies can pass on those costs to consumers, it may not impact the margins that much, but that's not going to be uniformly true. So in some cases, it'll start cutting into margins as well. And we're seeing already some companies starting to react to that. In Europe, Daimler announced that they were cutting back their earnings estimates because of the tariffs. And then we're also hearing from other companies, you've heard in the news, like Harley-Davidson, thinking about moving their production. And that's some of the unintended consequences of trade, the trade disputes.
Altman, can I jump in for a
Sure.
second? So we talk a lot about the impact of the trade war on the US. But if you look at the exports of US to China versus the exports of China to the US, and you also take into account that the US economy is much larger than the Chinese economy still, and isn't the impact of the war, the trade war, is much more significant for China than it is for the US?
It's likely to hit China a greater to a greater degree. And in the recent trade report, we were actually looking a little bit more deeply into the trade numbers at global value chains. There you're able to see the input-output relationship between industries, and that also shows that the dependence of the Chinese economy is greater than the US. So it does hurt China more. But to me, the primary motivation behind the trade disputes is more about protecting the U.S. industries in terms of technology transfers. And in some ways, the trade tariffs can be a blunt instrument to prevent that. But it does force the Chinese government to respond, and you get into this tit-for-tat tariffs situation, which we'll begin to see the impact first through prices. In the near term, the impact is probably not going to be great, but the medium and longer term, there will be larger impacts on the global economy through the trade channel, especially as the global value chains start to get disrupted. So the organization of production across borders is going to be affected, and it may lead to inefficiencies and hurt productivity all around.
Yep. Okay. What else is happening in the world?
So when we're looking at the leading indicators that are kind of these forward-looking metrics for the business cycle, it still shows that the global economy, many of the major economies are in expansion territory, and that's expected to last. But there are a couple of those trouble spots that are emerging. So the cumulative contribution of the countries that we follow is still positive, and it's been increasing for the US, China, emerging markets. But the leading indicators for the UK especially are signaling more trouble ahead. So the risk of recession is going up, and the team is going to come out with a blog later this week. So if you're interested in the UK economy, I would encourage you to take a look at that. Another area that's problematic is the leading indicators for Japan. And I believe those are the two reasons why you see the mature economies in the last 6 months contributing negatively to the global LEI that we're tracking. So those are some of the reasons why we kind of adjusted our 2018 outlook. You can see the detail in this chart. Most of the mature economies are doing somewhat more moderate than 2017, with the exception of the US, which is getting the stimulus, and it was already kind of having the fundamentally strong cyclical environment. The emerging markets are, of course, growing faster, and we do expect some moderation across the board in emerging markets as well. Of course, the oil exporters are probably going to benefit from the higher prices, although we don't expect their prices to continue to increase. They will probably stay at that moderate levels. So that kind of lands us at about 3.2% for the global economy. I'm having trouble with the charts here. Let me see. Okay. And here's kind of a longer-term view of those leading indicators. You see the moderation for the global LEI, which is the dotted line that's light gray. A lot of that is kind of coming from the euro area and emerging markets kind of moderating. Overall, the US is leading the mature economies, so there's kind of that continuation of that cyclical strength. I think this is my last chart showing a new global consumer confidence index that the Conference Board started publishing. This is based on an online survey of consumers in over 60 countries around the world. We took this over from Nielsen, and going forward it'll be a regular quarterly update of the global consumer confidence. And kind of looking across the board, you see a lot of those browns and reds, which show that consumer confidence is strong, especially in North America, emerging Asia, and most of Europe. And overall, consumers are benefiting from good labor market conditions, some increases in wages, so that bodes well for consumer spending and kind of a continuation of the cycle, the healthy cycle that we've been seeing going forward. So let me end there, and maybe there are questions, or we can kind of go into some of the details for the U.S.
Ottoman, you mentioned the idea of tighter labor markets around the world. And my question to you is, what role, we've seen that wages have not necessarily been picking up, certainly in many mature economies like in Europe and Japan. What role is globalization and the structure of supply chains playing in that dynamic, and how might that change going forward?
That's a good question. There is a theory that with the global integration of economies, the availability of large labor supply pools in emerging markets help to dampen down wage pressures in mature economies. There's some empirical evidence for that. So the workforce in mature economies like the US, Germany, Japan, maybe less so in Japan, but definitely globally integrated countries like US and the European countries, to the extent that companies can move their production elsewhere, that creates competition for their local labor force. And that helps to keep down wages. And that might be a factor in why we haven't seen a greater degree of wage acceleration recently, although wages have started to increase, and then I think you will see some evidence of that later on. There's another factor that is somewhat related, is that to the extent that production can be automated, or you use sort of factory robots, so more capital-intensive production, which is affordable in today's economy, that also creates a substitute for more expensive labor. So that can kind of lead towards downward pressure on wages, and that's something that we may be seeing.
Thank you, Ataman. So we're moving to the US, and Brian, what are the main trends in the US economy?
So I think the main trend that we're seeing is overall the condition of the US economy is extraordinarily robust. In the second quarter, we are expecting GDP to grow by 4.2%. That sounds a little better than what conditions actually are, because if you take the average from the first quarter 2% growth, you get a little bit over 3%. We're anticipating that given the policy stimulus, both tax cuts and also increased government spending, which is going to start flowing into national accounts during the second half of the year and continue having an impact through the first half of 2019, that you're going to see 3.1% growth on average for 2018 and the same for 2019. But you are going to see a slowdown late in 2019 as some of that stimulus is withdrawn, particularly the government spending, and also presumably interest rates will be much higher for reasons that we'll get into as we go along. The labor market continues to be extraordinarily tight, as Gad will show with great detail during the second half of our presentation. That's helping to boost consumer spending power, and also the fact that consumers just feel much more secure in their jobs, even if earnings aren't necessarily accelerating as quickly as we might expect. That fact is boosting consumer confidence and continuing to shape consumer demand. Even though these stimulus measures, though, are present, and generally the U.S. economy is enjoying a strong profit environment, there are factors that are giving business pause before taking a plunge in terms of making new investments. Tighter Fed policy is certainly one of them. We expect 2 more rate increases this year, 3 more next year, and one of the reasons for that is that inflationary pressure is starting to pick up, and part of that may also in the coming months be increased trade tension, which of course will raise prices for particular products. Higher oil prices and a stronger dollar will also play a role in boosting that inflation pressure and giving the Fed more reason to tighten interest rates, especially given the overall strength of the economy, and that may dissuade some firms from investing going into 2019. We are seeing, as Ottoman described, an ending of this global synchronized expansion that we're enjoying for some time, with Europe and emerging markets showing some signs of slowing down. So that may create less external support for US growth. And then finally, just the fact that there's uncertainty around trade policy that creates a reason to hesitate before investing. But overall, as long as business and consumer confidence, which are shown in the red line, that's our consumer confidence index, and then our green line, the CEO confidence index, both of which are showing continued strength. As long as those remain strong, we would expect growth to be able to maintain sort of this 3% tight pace that we've been seeing at least through the beginning of 2019. And the question is going to be, will those trade tensions, will some of the slowdown happening outside of the US, will that start to weigh on business confidence in some more profound way than we've seen so far? I mentioned inflation earlier. The notable line here is that blue line, which is the Federal Reserve's main indicator for inflation. That's the personal consumption expenditure price index for core products, excluding food and energy. And you can see that for the first time in around 6 years, and really the first time, it's been very rare during the course of this expansion to see that inflation measure near the 2% target. And you are seeing that, and the question is going to be, what role will some of these new tariffs that we're seeing play in boosting inflationary pressure even further, and maybe forcing the Fed to act a little more quickly in terms of raising interest rates? What you see in this chart is the price index for laundry equipment. Washing machines, of course, make up a large component of that laundry equipment measure. And the thing to keep in mind here is that these tariffs went into effect in late January. In April and May, prices for laundry equipment rose by around 17% off of a 20% tariff. And this is in spite of the fact that the vast majority of laundry equipment is manufactured domestically. Why did this happen? Well, components of new washing machines are covered under some of these tariffs, so that played a role, that the intermediate goods necessary to do the manufacturing became more expensive. And also firms realized that they were facing less foreign competition, and as a result were able to sustain price increases. And so as tariffs spread to a greater variety of goods, there is very much the potential for inflationary pressure to build, and that's one of the reasons why a trade conflict could exert negative pressure on US growth. So what are the main tariff measures that we've seen recently? Well, Nafta renegotiations have stalled for the time being due to both the recent Mexican presidential elections, which resulted in the installation of a new president, and then also the upcoming US midterm elections, which will make it very difficult to have further Nafta negotiations between now and the end of November. So I think you're not going to see much movement on that front, but there are already tariffs, particularly the steel and aluminum tariffs, that have required the EU countries, Canada, and Mexico to implement retaliatory tariffs against the US. And so the question is going to be, will there be new rounds of tit-for-tat tariffs, as Ottoman described earlier, and how will those develop over time? So is this going to be a trade conflict that for the time being is going to be primarily a China-US trade conflict. Just this past week, $34 billion in tariffs went into effect on Chinese exports entering the US. These included around 1,300 products. There's a focus on intermediate goods in the hopes of curtailing the direct impact on consumer prices. But of course, when intermediate goods are subject to tariffs, there is a loss of competitiveness for US exports going elsewhere, because a lot of the reason why we have seen a decline in prices is goods prices over time is the availability of cheap components from abroad. And then also, once China has now implemented equally large retaliatory tariffs on agriculture and automobiles as well. And in response, the US has already announced a possibility of imposing as much as $500 billion in new tariffs. Today, there was an announcement that a list of $200 billion worth of new tariffs were being prepared, and that would focus a lot on components of consumer goods, so that could have more of a direct impact on prices. The goal the US has behind these measures is to try to get China to change policy, both in terms of opening up Chinese markets to US goods, and more importantly, from the perspective of the Commerce Department, trying to reverse technology sharing provisions that are required for Chinese market access for US companies. Basically, the fact that US companies, when they enter into a joint venture, have to share certain technologies with China. So far, these measures haven't had much of an effect on Chinese policy, and we'll see going forward what exactly the full risk created by these tariffs will be. I think it's important to keep in mind the value chain perspective that Ataman described earlier, because even though we've seen most of the US tariff measures focus on components rather than final goods, that's going to cause firms to have to scramble in terms of making supply chain changes. It's also going to require consumers to see the prices of particular goods increase. And the key thing to remember about trade agreements is that they control tariffs in a mutual way, so that domestic pressure from individual firms that have an interest in particular tariffs on particular products does not overwhelm sort of this general free trade environment. When that's withdrawn as a result of a trade conflict of this nature, tariffs can increase quickly, dramatically, and cover a very broad array of products. Now, it's important to remember the US is a very large market. It has less than 15% of exports in GDP, and that's much less reliance on exports than the key trading partners involved, China, the EU, and the Nafta zone countries. But even so, you're dealing with a three-front trade conflict. And also, there's a tremendous disruption to business that has the potential to occur simply because you need to find new sourcing arrangements. So I think two things are important to keep in mind. First of all, as the stimulus measures are withdrawn, particularly the increased government spending, is that going to expose the US to an increased risk of a downturn? And then also watch how equipment investment evolves at the firm level, because that's going to be a critical indicator for how exactly firms are responding. And this chart illustrates that dynamic pretty clearly, because what the red line measures is shipments of non-defense capital goods, which is a good measure of capital equipment. And what we're seeing is that growth in these shipments has continued to remain relatively strong, but it clearly has slowed. So far, the blue line, which is a measure of business confidence, manufacturing confidence in particular, has not seen the same level of decline. Now, it has declined some from earlier elevated levels. And so if you start to see that firms are purchasing fewer computers, less plant equipment and things like that, that is a troubling sign for how trade is impacting firm decision-making and firm strategy in terms of thinking about making investments, and that firms are getting hesitant as a result of what may happen to their supply chains as a result of further trade conflict. So finally, how does this all play into our outlook? Well, as I mentioned, GDP should remain quite strong through the first half of 2019 unless this trade conflict builds in a truly precipitous way. Consumer spending is likely to remain strong given the labor market dynamics. Exports definitely contributed more to the second quarter than you would expect going forward given the overall strength of the dollar. And if the trade conflict widens, you're going to see a decline in exports and imports as well. So that may not affect the trade balance quite as much, but where it will have an effect is in this non-residential investment component, particularly in terms of equipment spending. And I think that bears watching as we think about what the impact of the growing trade conflicts are for the economy as a whole.
Thank you very much, Brian. We are, just to remind our audience that if you have any questions, you please type them in our chat box and we'll take them as they come. So now we are moving to the labor market part of the presentation. We have 30 minutes of labor market goodness ahead of us. So let's start with some overview. So I think the main message that we want to convey, or let me step back first. So we are in a tight labor market in the US, and the labor market is tightening as employment is growing quite rapidly, whereas the labor force or working age population is growing more slowly. So as a result, unemployment rate is going down and labor markets are tightening. What we are doing in a new report that will come out later this summer is we try to see where within the US labor market we're seeing more pressures. And our main conclusion is that at the moment we are seeing a much tighter labor market for blue-collar workers, which is was not the case for the majority of the past 20 years, where it was the high-skilled workers that felt more labor market tightness. So we are going to try to explain why we see that trend. One of the outcomes of this trend is that in the overall disappointing wage growth that we're seeing so far, blue-collar workers are seeing a much faster growth than white-collar workers, which is also a deviation from a long-run trend. By the way, before I continue, just to tell you what we mean by blue-collar versus white-collar. So blue-collar are kind of pure blue-collar occupations like transportation and construction and manufacturing and mining types of jobs. But in this category, we also include the low-pay services jobs like food services and health support and security guards, and there are a bunch of services groups that are actually get paid less than the pure blue-collar occupation. So we group them kind of together. The white-collar occupations are management, business, finance, professionals, and also sales and office-related workers. So just as we move forward, that's what we mean by white-collar versus blue-collar.
But I find it ironic yet that management and finance occupations are considered to be white-collar jobs, considering when I look at our panel, we have 2 out of 4 blue collar. So how exactly did this distinction come about?
Well, we want faster wage growth, so we want blue collar. Yeah. So it's not easy to solve the blue collar labor shortages issue, because some of the solutions that are available for example, for white collar occupations, like using remote workers or offshoring or delaying retirement, those are options that are less available for blue collar workers. So we think that it's probably going to get worse before it gets better. The main solution that we see for this is the automation. So blue collar jobs are more likely to be automated, and that's probably the main solution for that issue going forward. But you know, the future of automation or productivity growth is a very uncertain future, and that's another project that we'll take on in the next several months to see what types of jobs are being automated right now and are likely to be automated in the near future. We're also going to talk about labor market conditions across states. So some states have tighter labor markets than others. In particular, the Pacific region is now the tightest labor market and also has the fastest wage growth, particularly California. While California, the population there is not growing very rapidly, so there is a lot of working age population workers who are leaving California, and the growth rate there is is kind of average. There is a lot of employment inflow into California, so California is already one of the tightest labor markets in the U.S. In discussing labor market tightness across states, we found that we need to create a new measure of labor market tightness across states, and together with Frank, we created one, so we're going to show it to you and especially show you what the results and the drivers of the different labor market conditions across states. So let's start with some data. So in this chart we see the unemployment rate in the blue line, and it is on a downward trend. In the last months, in June, it actually increased a little, offsetting part of the decline of the previous 2 months. But clearly, the trend is downward, and if our forecast for economic activity is correct, then we're likely to see this trend continuing with employment growth growing faster than the labor force, and as a result, the labor market continues to tighten. As a result, we are experiencing some gradual increase in wages. We see that in the red and the green lines, that are two of the most popular measures of employment growth. So both of them showing an upward trend in recent years, but they are both still well below the pre-recession rates. So with the tightening of the labor market, we're probably going to get closer in the coming year. But when we break down the unemployment rate for different groups of occupations, an interesting picture emerges. In this slide, we show the current unemployment rate for versus the year 2007, which was the peak of the previous expansion. So what we see here is that the blue-collar occupations, so those are production and transportation, natural resources and construction, and those low-pay services that I mentioned before, there the unemployment rate is significantly below the 2007 rate, whereas sales and office is just a little bit below the 2007 rate, and surprisingly, the bulk of the white-collar occupations, management and professionals, which are the highest skills workers at the economy, there the unemployment rate is still above the 2007 rate. Now, this is not a perfect measure of labor market tightness, but it is the best we have, I guess, by occupation. So that suggests that, surprisingly perhaps, but the labor market is tighter for blue-collar workers than for white-collar. Now, we spend a lot of time thinking why that is the case, and we think there are kind of convergence of several trends that are all working in the direction of making blue-collar occupations especially tight. So I think the first one is a long-run trend where the labor force is becoming more educated over time. So there are fewer people in the labor force, fewer share of the labor force that have a high school degree or less, for example. Yet the blue-collar and manual services jobs, their share in employment remains roughly constant since 2000. So while we have the same share of the jobs that requires low education, the share of workers with low education is rapidly declining. So that's potentially one reason. Also, the stigma of manual labor in the US is not helping the supply of workers into those occupations. That's not the American dream to do manual labor anymore. And in addition, the insufficient vocational education opportunities are not helping as well, especially when you compare the US to some countries in Europe, and particularly Germany, where this is a much more thriving industry. Also, there are in many of those blue-collar occupations, there are a lot of older workers who are about to retire, and so this combination of a large number of retirements and relatively few new entrants is creating a constant pressure on blue-collar occupations. This pressure was not evident in recent years when the whole labor market was weak, but as we kind of move to a tighter labor market, we are seeing that the impact of the tight labor market first and certainly more visibly in blue-collar occupations. Also, in terms of solutions, there are the solutions for labor shortages in blue-collar occupations are more limited. So, for example, in many white-collar occupations, we see a very large share of people working from home or in remote offices. In many blue-collar occupations, you have to be where the consumer is, and that is limiting the solution of teleworking or remote working. So that's another barrier. Also, in many of the blue-collar jobs are physically challenging, so it's harder for people to remain welders and construction workers into their late 60s or 70s. Whereas in white-collar jobs, it is much easier to do that. Also, the immigration crunch on undocumented workers in the past year is having more impact on blue-collar workers, because most of the undocumented workers are in blue-collar and low-paying services occupations. There's also potentially a concern when young people are choosing a career, is that they are concerned about future automation. So if you're considering becoming a truck driver now, for example, you may be worried that in 10 years your job will be eliminated, so that may reduce the current supply of truck drivers. So while new automation is probably the solution to the labor shortages in blue-collar workers, it's also perhaps a deterrent in the immediate present. And as I said, probably the biggest chance of solving the blue-collar labor shortages is through automation. most of the job that can be automated are in the blue collar and low paying services jobs. So far there hasn't been in this expansion a great incentive for companies to automate much because the labor was available and cheap and profits were high. But as we move forward, they may have more incentives to automate. So we'll maybe, if you kind of force your eyes to see a trend, you see perhaps some increase in productivity growth in the past year, but it's too early to tell. So some data on that. So I mentioned that the labor force is becoming more educated. In this chart, you see the four groups in the labor force: people with a college degree and above, people with some college, people with a high school degree, and people with less than a high school degree. And you see that both people with high school or less than high school, their share in the population is in the labor force is declining over time, and the share of people with a BA and above is significantly increasing. Now that would be okay and even good if the demand for jobs is in line with those trends. But if you look at this chart, here the four groups, so if you look at the two ones at the bottom, that's the share of the blue collar occupations, and the gray line is the low paying services occupation. So if you look at both of them together, they almost remain at the same share since the beginning of 2000. So while the number of workers who want to take, who are willing to work in those occupations is declining, the demand for those jobs remains more or less constant. So that is creating a mismatch in the direction of not enough workers willing to work in blue collar and low paying services jobs.
I think one important point about this chart, Gad, is that automation is not necessarily a linear process. You can see with this blue collar line that the share sort of was gradually falling throughout the 2000s, dove steeply at the time of the Great Recession, and then has basically been flat ever since. So I think the thing to look at is that production occupations are much more exposed to cyclical dynamics. The next time there is a recession, those firms are going to have to cut back radically. That's going to require more investment in automation and other types of technology. And that may be the time when you really see more of a transformation in the workforce. So until then, it's likely to remain a very, very tight labor market for those types of functions.
Mm-hmm. Yeah, a lot of the adjustments happens in crisis time. So all we need is another crisis.
Yeah, if I can also, so at one point, Brian was talking about automation. But if automation is not an option, we have been talking about downscaling. Mm-hmm. And employers could also, of course, think about it to provide more training. So to hire somebody that maybe before would not fall into their category of having enough requirements, but then you just provide more.
Right, no, that's
training.
an excellent point, and I should have mentioned it in the text slide before, because we did a blog on that, and we are seeing that in recent years, as the labor market gets tighter, kind of low-paying jobs are reducing the hiring qualifications. So we see more people with just a high school degree or even no high school degree being hired. So that's certainly something that is easier to do for those jobs than for medical doctors, where you can just take someone from the street. I hope not. Yeah. Another solution that is available more to white collar workers than for blue collar is using teleworking. So what we see in this chart is the share of people, full-time employees who work primarily from home. If you look up and down this chart, you see that a lot of the, or almost entirely all of the jobs that are at the bottom of this list, meaning that they don't use teleworkers, are in either blue-collar or low-paying services. So for many of those jobs, teleworking is not a solution. Also, this is highly correlated with offshoring. So a job that you cannot telework, you can usually not offshore, with one big exception, and those are production workers, which you cannot do it from home, but it's known in recent decades that a lot of employers have shifted production jobs into other countries. So that is certainly for production workers, offshoring or moving to a cheaper area within the United States is a solution. So let's talk a little about wages. I want to leave time for the geography part. So tighter labor market also ends up in faster wage growth, which are divided into blue collar and white collar occupations, and there's certainly much more acceleration in recent years in the blue collar as opposed to most of history, where white collar wage growth was faster. We're also seeing it if we divide it to blue collar versus white collar, the most recent groups of occupations, most recent period, all of the blue collar occupations have faster wage growth than all of the white collar occupations, which is interesting. So we are now moving to the labor market conditions across geographies. So Frank, you want to take us through that?
Yeah. So our main objective here was to build a labor market tightness measure by state, and a labor market tightness measure by state that would go beyond just the unemployment rate. And why did we want to go beyond the unemployment rate? We wanted to go beyond the unemployment rate because the unemployment rate only takes one portion of the population into account. It only looks at the people that are in the labor force. And the people in the labor force, that are the people that are either working or the people that are actively looking for work. So we, Get and I, asked ourselves the question, how big is the chance that somebody who is not in the labor force, how big is the chance that they will actually find a job in the next month? So we started looking in the population at all groups, and basically we divided in the labor force and non-labor force. So in the labor force you have the short-term unemployed, the long-term unemployed, that are the people that you know from the unemployment rate. But we added the part-time, the people that work part-time for economic reasons, because maybe the next month they find a full-time job, start working more hours, and in that way alleviate a labor market tightness. In addition, and most importantly, we looked at people outside of the labor force, so that are, for example, the marginally attached, that are people that want a job but just have not recently been looking for a job. In addition, we have the disabled and the retired that say that they don't want to work, and we have a big, large residual group of people that they say that they don't want to work for other reasons. So our next step was to look at the probability that a person from one of these groups would move into employment. And we found that, as expected, people who were short-term unemployed had the biggest chance of finding a job in the next month. That were about 3 in 10 people. When you go already to the long-term unemployed, this chance is much smaller and not larger than, for example, the marginally attached. For the disabled and the retired, the chance of returning to the labor force is almost zero. But interestingly, and this was, for me, my biggest insight, perhaps for you too, that people, even though they say that they do not want to work for another reason than being disabled or retired, actually 1 out of 10 finds a job in the next month. And this confirmed our belief that we should not only look at the labor force, like the unemployment rate, but look at the whole population. So basically, in the end, we combined all these different groups into our labor market tightness measure and weighted each group according to its probability of finding a job in the next month.
Yeah, and and we applied this for each state to create a labor market tightness by state. But we should mention that this, we are not the first people who thought about this idea, and actually at the national level, someone already thought about it.
Yeah, at the national level, there were researchers from the Richmond Fed who did almost the same exercise. So that is what I want to show in this chart here, and also to let you see what the difference is between the unemployment rate and the labor market tightness measure that is more extensive. So the blue line here shows the more extensive labor market tightness measure, the red line, the headline unemployment rate, as you know it from the news. And the unemployment rate would suggest that we're already in a tighter labor market than we had just before the recession. The other labor market tightness measure, however, shows that we are currently at the same tightness as just before the recession, and would suggest, if we believe we can get back to late 90s labor market tightness, that there is still some slack in the labor market. Of course, this is still open for discussion, but in the next slides we can go into each state and show where we believe there's still some chance for business to find people that actually want to work. So now going to our labor market tightness measure by state, we're looking here at the map with in dark orange the states that have a tight labor market, and the states in more blue colors that are the states with looser labor markets. To understand the label, we are comparing here the last 12 months versus a long-term average, in which we excluded 2001 to 2003, because these years were affected by a crisis or by a recession, and therefore are maybe not best to take into account for a long-term average. So to look at the map, California, Kat already mentioned it before, has a tight labor market, and that is especially interesting because it was not like that 3 years ago, 2 years ago. It has especially been growing much faster, has had strong employment growth, especially in the last 2 years. Looking at Nevada, for example, the state that was hardest hit after the crisis, it's not a surprise that it is still in a relatively loose labor market. Then on the South Atlantic, we see that there's still some room. And in addition to that, I want now to focus on the states Maine, West Virginia, Mississippi, Alabama, because that surprised us a little bit. Why are these states tight? And Kat already mentioned it also for California, has strong employment growth, a bit slower population growth. And that is the same for Maine and especially West Virginia, where population growth is even negative. In addition, however, and this is where one of our components of the tightness measure comes into play, and that can explain why the labor market is tight in West Virginia, that is because they have a large share of disabled people. And that is what we're looking at in this map. You see Kentucky, you see West Virginia, Maine, Mississippi, Alabama, and they have a much higher share of disabled people compared to other states in the United States. And we know that disabled people have a very low chance of returning to the labor force in the next month. So simply this fact means that in these states, in these orange states, that the available pool of workers is just much smaller than the states next to it.
We should mention that when we say disabled people, that's self-reported. So when people ask what's your labor force status, they say, we're not in the labor force because we're disabled. So it doesn't mean that actually there are 3 times more disabled people in West Virginia than Utah, for example.
No, thank you for adding that. Then in the next slide, on perhaps a more positive note, and I would say this is interesting for HR managers that are into recruitment, we're now looking at the map and the share of people that say that they do not want to work for other reasons than being disabled or retired. And you can see California, Texas, New York, some states in the South Atlantic. And we believe this is an opportunity to find out and to identify who are these people. And Kat and I are going to do more research on that to find out, because this is a pretty big group, and especially if you are out of options and you don't know if you still have enough people that you can hire in your state, then maybe you should be creative and look into different options. So that is maybe the main takeaway for us from this labor market tightness measure and from this slide.
And as Frank showed earlier, the Pacific area, in particular California, but also Oregon and Washington to some degree, they had the tightest labor market or among the tightest labor market in the area. So what we looked here, we looked at wage growth across the 9 census divisions. We took 2 measures, one from the Employment Cost Index and one from the Fed Wage Tracker, and we averaged them. So clearly the Pacific area has the fastest wage growth in the past year. So it's the tightness of the labor market, and especially the recent tightening of the labor market, is having an impact on wages in the Pacific. So probably moving forward with a tighter labor market and faster wage growth, companies in some cases will consider whether the Pacific is becoming too expensive for them, and they would look elsewhere. So that relates to the project on business geography that will probably at some point in the future we'll have a webcast on that. What are the labor market implications on location choice? We are kind of out of time, so I just wanted to mention a few other webcasts that we'll have. As usual, we'll have the regular Economics Watch series and portfolio of products. Next Economics Watch webcast, the American Shopper, the impact of rising income and growth on spending patterns. So Brian will be back here together with me and Ilaria. And there are a few other interesting publications and webcasts that you may want to take a look at. Particularly, there's a webcast on window on trade dispute on July 25th. Brian, are you going to be there?
I am not going to be there, but we will have an all-star panel to give you the latest up-to-the-minute developments in how tariffs are evolving.
Yeah, so that should be interesting. So I want to thank Brian Atterman and Frank. Thank you very much for being here with me. I want to thank the audience. And if you have a minute to fill a quick feedback form, we would appreciate that. And looking forward to seeing you in the next Economics Watch. Thank you. Goodbye.